I think the sooner you could start and get that momentum going, I think the rates today are a fair price. And if you can make it work today, the investment's going to be that much better if rates go down. If you can make it work at this rate, when rates drop, it's going to be all gravy on top.
Welcome to another episode of Wealth Wednesday. I am your co-host, Nate Crannell, joined as always by CEO of Grand Vision Companies, Mike Neubauer. How are you, Mike?
I'm doing great, man.
Awesome. Let's dive right in. There is a lot of conversation going on right now, both sides of the aisle, all sides of the geopolitical space around interest rates and inflation. There's one side that says, rate cuts are coming. The Fed's going to start cutting rates from Q2 to Q4. Other people that are thinking more geopolitically around the world are thinking that rates are going to either stay where they are or go up in the next couple of years. Kind of what are your initial thoughts?
I was kind of in the boat of rates would be coming down probably about 6 months ago. I kind of thought that there'd be a little bit, they call a soft or hard landing. I thought it'd be hitting us a little bit harder right now. We had some bank failures and things were kind of looking like we might be going into a recession. Now some things have changed, and with those changes, it seems like potentially rates will not only be staying where they're at, might actually be climbing a little bit. And month after month, the reports have shown inflation kind of staying right around that 3% mark. So, I don't see anything minus a catastrophe of some sort, an economic issue popping up that would cause rates to go lower at this point now.
For sure. How much of that do you think is related to the presidential election that'll be coming up here in about 6 months?
I think we're going to see more coming up prior to the presidential election. I think they have really held off so far, and the poll numbers and kind of the feel, Trump has a lot of stuff going on with the court battles, so a lot of that stuff wasn't played out. So I don't think the interest rates have really played a ton into that yet, but for sure, I think as summer progresses and we start to get a little closer, there's always some potential for some of that. But right now, I would say probably not. I think the rates in the economy are all kind of running their course outside of the presidential election.
For sure, I would agree. I think Trump's got enough stuff on his plate that he can't really be focused on this. Biden doesn't know what day it is, but regardless of that, what he's thinking about and any influence that he might have around this, around the election, he's probably going to revert back to COVID, right? I think most of the inflation that we've heard about over the last couple of years, and at one point we got all the way up to 9%. Like you said, we're back down near 3%. A lot of that's been COVID related, right? There was logistical issues, and there was every time a new variant would come out, that there would be, adjustments in people's consumption, and can we go out, can we not, all those types of things. And I think there's just been enough adjustments over the last 4 years that Biden could probably lean his hat on that and say, like, hey, we got through COVID together. The country's been open for, call it 18 months, 2 years, depending on which state you look at. And things are kind of leveling off. And I think that's why we're at 3% now. I just don't know if we get below 3% from an inflation standpoint to justify interest rates moving. What are your thoughts on, let's knock out inflation first, and then we can talk about interest rates the rest of the time. What are your thoughts on that 3% inflation number?
Yeah, you hit on a little bit of the COVID causing the inflation. So there's no doubt you break the supply chain. Everything was coming out of China to the U.S. You stop all of that transportation. You back everything up. Demand didn't drop, but supply quickly dropped and prices go through the roof. Even like used car prices went through the roof because to get a new car, the lots were empty. So everybody switched to used cars. So COVID had a huge inflation. However, COVID isn't really the cause of this inflation now, but kind of in a back way it is, because now the United States and really all of North America saw the supply chain issues that could occur if there's a global problem. And because of that supply chain and also some discontent now with China, they're looking to onshore or nearshore, Canada, the United States, and Mexico, bring a lot of that manufacturing back in-house. That way we're not reliant on the countries out in the East. And because of that, bringing that stuff back in-house, it's kind of keeping inflation at a relatively high point, because there's a big cost that comes with onshoring and moving manufacturing from China back to North America. There's a big cost in the fact that the labor and the cost of manufacturing those goods are going to be more expensive here, but also there's a buildup cost. So as you start to break ties with Chinese manufacturing, but you haven't yet started the manufacturing process in the United States, that still creates a slight shortage because you're cutting back on one spot and you haven't rebuilt that in the new spot yet. So for some of those reasons, it's not necessarily COVID related, but COVID kind of pushed the hand towards this nearshoring and bringing manufacturing back home, which will likely be a good thing in the long run. But it also means inflation's probably not going anywhere outside of some sort of a recession causing it to go down.
Sure. Kind of a perfect storm, right? Of China's economy and their housing market failing, that the rise for American economy, or not economy, but industry kind of becomes more important, right? And we start thinking about it. But exactly to your point, to actually start building factories, building warehouses, that takes time to build that infrastructure before it truly, starts the manufacturing process. Why is it then, do you think that, if we know that's the thought, everyone knows that China's struggling at the moment. Everyone knows that the made in America is starting to come back and people are craving that. There's a demand for that. Why is it there's still that one side of the argument then that says, oh yeah, rates are going to start dropping here pretty soon? Why, what viewpoint do people have that make them say that?
Some of it is just bias. I mean, I wish rates would drop. So I'm kind of going into the argument saying, I really hope rates drop, and then trying to base my argument around my desires. So some of that is, goes that way for people. And then the other side is a lot of people just saw a lot, we have quite a few apartment units, and we saw definitely a period in which we had delinquencies that we never had. We had a way downturn in applications. Everything was kind of set still. And that made me think we were just going into a recession, because I saw firsthand across, the Midwest, and we have, the apartments, different areas, delinquencies, lack of applications, which says middle America is starting to struggle. Well, now all of a sudden we're seeing kind of a swing back the other way, and we're starting to stabilize again, and money's starting to rise. So I think a lot of people were expecting that moment of what felt like recession and what felt like leading into a recession was coming, and it was going to be worse than it was, which it still could be. I mean, it's going to ebb and flow. There's going to be good and bad times. But myself, and I think a lot of people, thought that what they were seeing was just a start of a continued downtrend, which could only be saved by lowering interest rates. And what we're seeing is interest rates have stayed strong at that, 5% roughly by the Feds, a little bit more. But the economy is still pushing through, and we never kind of went off that cliff that people were expecting. So because we didn't go off that cliff and the economy is staying strong, there's really no reason to bring rates back down.
Yeah, great point. I think the other thought that the Fed might have, and then obviously any communication that they put out, and so people kind of go, well, we've had crises in the past, right, that we've bounced back from, right? We had the dot-com crash, the subprime loan debacle at 2008, and those took time to recover from. And so I think, again, back to COVID, I think people are using COVID as that pinnacle point, and they're just saying, well, now we're in that recovery period. The Fed should be dropping rates, right, to kind of speed up that those adjustments. Do you think that's still accurate?
Well, I mean, they did that already, during COVID. So they dropped rates to zero.
Yeah.
They put a bunch of money out into the economy. Trump lost the election. So right before he lost the election, he put a bunch of money out. Biden got in and won the election. So to match it, he put a bunch of money into the economy. So there's a huge supply of cash that hit the market, which drove up the inflation. And the rates were at roughly zero for quite a while. So I think we're kind of through that. And now we're just waiting for that cash to all kind of work through the system at these higher rates and kind of get back to a stabilized, which I think over the last couple months, so basically in 2024, I think we've seen a lot of stabilization. We haven't seen big spikes in inflation. We haven't seen huge drops. It's been pretty consistent month after month, same numbers, which is good to have consistency, but it's not good if you want interest rates to drop, because that means that if we're having consistency at this level, we'll probably maintain this level until we see either a drop or an increase in inflation.
For sure. Do you think there's there's specific demographics, within United States residents that are going to lean more towards, I think rates are going to drop, and then others that may lean towards, I think rates are going to go up? I think of a lot of the folks that we work with who are high income earners. They've got to be thinking rates are going to drop, right? We want to borrow, we want to get capital out, and put it to work. Do you feel like those are going to be the folks that are going to be focused more on, or at least have the belief, not focus, that the interest rates are going to be coming down just simply because they want them
Yeah, I mean, I just speak very transparently. I think most of
to.
America doesn't have a clue where interest rates are. They know they see in the news that they're up, but they don't really know how high they're up. They don't really understand how the Fed funds rates work. They don't understand why it affects interest. They don't understand that the savings account now pays 5% and it used to pay 0.1%. I think most people don't understand that. So I think most of it is not really an economic viewpoint. I don't think people really dive into it at that level. What I do think happens is people see that shock. So they used to see a mortgage rate of 3%, and now they're seeing a mortgage rate of 7%. And they think, man, that's crazy. That's so high. I'm going to wait for it to drop closer to what I feel is normal. And the only reason you feel that is because it was that for, quite a while. And but as time goes on, that 7% starts to feel more and more normal just because you keep seeing that everywhere, and that 3% becomes a thing of the past. So I just think it takes time, a year or two of people starting to talk to their friends, and their friends say, I got a 7% interest rate on my mortgage. They refinance, I got a 7%. They go buy a new house, I got all of a sudden that 7% becomes a new emotional normal. And then people start to kind of get back out there and buy things at that 7%. So as much as we would like the rates to drop, and I don't believe they're going to, from an emotional standpoint, and people going out and deploying capital, buying a new house, doing those types of things. I don't think necessarily they depend on the interest rates as much as they depend on the emotional feeling of that they're not getting screwed, that they're getting a good deal. I think people are fine paying, say, 7% interest rate on a house, as long as they don't feel like tomorrow it could be 5% and they missed out on a deal. They don't want to pull the trigger too soon. But the more consistency we see, the less likely it is that you're getting screwed at 7%. It's just the normal, and the more the public is willing to go out there and borrow money at 7%.
Got it. So you think we had that point recently where there was kind of like that, whoa, pause. Like there used to be 3%, now there's 7. I'm going to hold on, and so their mindset around consumption, kind of goes on hold. You just feel like over the next 7 will become the new normal, and eventually, I do think rates at some point down the road, whatever that point is, will come down, and then that's when people will get excited. You'll start to see the refinance market increase and more capital getting deployed. But you just believe that we're past that pause moment. Now we're kind of in that stabilization, trying to figure out, okay, let's make this our new normal and help us feel a little better, before we start consuming.
Yeah, I mean, we see it in the housing market. People
Mm-hmm.
people move in with mom and dad because they're going to buy a house. All of a sudden, interest rates went to 7% before they got that new job. They missed the 3%, so they said, "I'm going to move in with mom and dad until rates come back down." They've now lived there for a year. Now things are getting a little tight. You've had some arguments with mom and dad. Now you're starting to see interest rates aren't coming down, and you and your husband now are like, let's just go and buy a house. So we can't buy the $400,000 house that we wanted to. Let's buy the $350,000 house, and we'll pay 7%, but at least we'll have our own home. So I think there was that period in which people adjusted their life because they thought these rates are too high. They got to come back down. But now life has normalized at these rates, and they've now decided, let's just go out there and buy a house we'll just buy something a little bit less.
Is there any factors? Is there any data or indication that the folks who do believe, I think rates are going to be coming down soon, is there anything to support that everyone else who's watching this, or anyone else who doesn't know but might pay a little attention, should be looking at to say, okay, there is something, a little meat behind this thought?
Yeah, I mean, we talked to some of the guys that we follow. My favorite phrase is compared to what, right?
Mm-hmm.
So the when you look at the economy, what they talk about when you're looking at the U.S. is the amount of national debt, the GDP to debt. We have a ton of debt right now, and now we're paying, because rates are high. We, as a country, we take those rates as well. So we're paying much higher rates on the debt that we have, which just compounds to higher and higher debt levels. So that's kind of what people say, is that can't last forever. That has to break at some point. However, up until this point, it has lasted forever, and we haven't seen a breaking point. So most people, the belief is just that when you start seeing a fracture where like a bank collapses and you see national debt skyrocketing, you think it cannot go on like this forever. It has to break at some point, and when it breaks, we got to bring interest rates back down. However, from a worldwide view, the United States is actually doing quite well compared to other countries. These other countries are starting to see the break, and actually the dollar is starting to get stronger and stronger against other currencies, which is forcing the hand of other countries. So although it seems like our system can't last forever and the rates have to come back down, actually our rates are fine, and other countries are being forced to look at dropping rates to try to increase their economy. And then you add the nearshoring, bringing manufacturing back home. The United States, even with the skyrocketing debt load, it seems that it has a huge growth opportunity coming ahead of it. You sprinkle AI in there, which is, just an efficiency multiplier to be able to do more work with less human input at a lower cost. It seems like the growth of the economy and the potential growth there makes a 5% interest rate seem somewhat normal, where you don't need a 0% interest rate anymore to force that kind of growth.
Gotcha. So you're saying that a lot of the great factors you just mentioned, people are seeing the potential, right? Here's all these different things. It has to change, right? They rates have to go down. And it's kind of, you always end the sentence with comma, right? Like they have to come down, right? And
Yeah.
so I think people just see you made some great points there as far as the different factors that are out there that as people are watching these moving parts, they could say, well, because this is happening and because there's this, strong belief, like they have to come down, right?
Yeah, I mean, there's a ton of
Yeah,
red flags out there, that are identifiable. It's very obvious to see a ton of red flags in the economy that makes you think, man, that's definitely going to break. Even we look at the commercial real estate world and the office buildings and the amount of unleased space and the debt burden coming with that as a rollover debt. But so far, that's turned out to be okay as well. And banks are kind of working with the owners to try to refinance those and kind of kick the bucket down the road. So as many red flags are out there, there's also a ton of momentum in the economy pushing it forward, which is keeping unemployment down. It's keeping inflation around that 3%. It's keeping the growth, kind of on track. So in spite of all the red flags, the momentum seems to be pushing pretty strong, in the positive direction still.
for sure. So I think in summary of this side of the coin, when we think about the people who believe that rates are going to be coming down soon, there is a lot of potential there, right? There are some things that could lean anybody to believe that this side of the coin is what's going to land. Let's talk more about the other side of the coin, the people who believe that rates are either going to stay the same or go up. So I recently read an article or saw a video actually from geopolitical expert Peter Zion. He was talking about the personal consumption expenditure index, which is essentially what the Feds use to measure inflation. It actually ticked upward. And I think a lot of people were expecting it to tick downward. And when I say a lot of people, I mean Wall Street. So the Wall Street hopefuls were kind of betting that Q4 of last year, Q1 of this year, that we'd see a handful of rate cuts. And we just haven't seen those. Obviously, the Federal Reserve dictates that, and they don't seem very interested in doing what Wall Street wants to do. With that, Peter believes that we won't see significant rate reductions for the next 2 to 5 years. As I say 2 to 5 years, what's kind of your initial thought in that space?
Yeah, I mean, I could see the same. I think historically, this 5% federal funds rate is somewhat stable and normal. It's not crazy high by any means, but it's also not crazy low like we had at 0. I think 2 to 5 is, that's kind of based on everything going as planned, which we all know that 2 to 5 years, things never go as planned. So that's assuming no black swan event, nothing happening, no sudden market sell off, no sudden COVID type thing popping up. So if all the numbers stay on track and everything goes as planned, where the variables don't change for the next 2 to 5 years, I could definitely see it staying the same. I think if inflation stays around this 3%, just a little bit below mark, I don't think there's any reason for the Feds to raise the rates. I think that's a totally stable number for them as long as they see that stability. And there's really no reason to drop it because there's just no benefit to the overall goal. But like I said, that's with everything staying the same and consistent and no variables changing, which over a 2 to 5 years timeline, I think is very unlikely. So, I mean, I think it's important to stay a part of it and pay attention to it to try to make some best guess probabilities, but at the same time, realizing that at any moment it could change and then being ready to pull the trigger. For instance, if you're at a 6-7% interest rate on your house and all of a sudden there's an event that, spooks the Fed and they drop rates suddenly, to lock in that refinance because you don't know how long you'll have those rates. So yeah, I think I would hope that the rates come down, but I mean, as long as they stay the same, at least you can make wise decisions and, safe investments, knowing what to expect. The problem is when things go not as planned, that catches you off guard.
For sure. And so having that off guard, I was just thinking as you were talking there, you kind of answered part of my next thought, which was, for all the leaders in healthcare that listen to us and listen to this podcast, specifically like the physicians that we work with, what should their mindset be over, let's say it is around the next 2 years of they're wanting to get capital, they're wanting to borrow. Should they still be in that like, hey, let's pause and hold and see what happens type mindset, or should they be like the ready alert? Because this is going to be right now is still pretty cheap to borrow money. It could get worse, right? There could be more increase in the next 2 to 5 years if Peter Zeihan is accurate. What type of mindset should physicians be in right now?
Yeah, I mean, it all depends. I'm very much of the mindset never to borrow money for a liability anyway. So taking a car loan out or something like that, it doesn't matter if rates are 0 or rates are 20%. Any sort of liability, I would not. But if you're looking to start a practice, if you're looking to do an investment property, you're looking to invest in a business. I mean, yeah, I think the momentum going forward is worth starting as soon as possible. So in America as well, we have kind of the best of both worlds. So we have what rates are today, but if rates go down, you can always refinance and lock in that lower rate. If rates go up and you started today, well, you're locked in with what you had today. You're not stuck getting that new rate. So I think always just to make, wise investment decisions, which would be not overindulging in a personal residence and taking out a huge mortgage payment. That's just going to be a liability. And then anything that's borrowing money for liabilities that are going to take money out of your pocket. But any sort of an asset, which, starting a practice, investing, starting a business, stuff like that, I think the sooner you could start and get that momentum going, I think the rates today are a fair price. And if you can make it work today, the business is just going to be, or the investment's going to be that much better if rates go down. If you can make it work at this rate, when rates drop, it's going to be all gravy on top.
Absolutely. So yeah, Peter ended that video, kind of his last final momentous thought was like, he just said, bottom line, if you're going to borrow, do it now. While capital costs are higher than they were, let's say in 2020 or 2021, this is still one of the cheaper times, for capital costs that we're going to see in the next few years. So I think for anybody listening that's thinking about a specific, investment property or getting into real estate or starting a business, like you said, and they do need to borrow, for that asset, I think now is the time to do it. This is kind of you're kind of on that. I just picture like standing in the middle of a teeter totter, right? You're safe because you're not tipping either way. If it goes down, you just slide down to the downward, and you get a loan for 7, and all of a sudden it's 5. You just refinance out, but it's going to be hard to go up a teeter totter when you're standing in the middle. And so now makes it feel like the most stable time to do it. Would you agree with that?
Yeah, and asset prices, business prices, all that stuff is going to be affected by rates. So I think that the rates have been where they're at for a while now. So prices have kind of stabilized, and they're not really waiting anymore to see, will rates go up, will rates go down. So that market is kind of stabilized in what the prices are. So yeah, I think a lot of people miss the fact they focus on that interest payment and they miss the opportunity cost of not getting started. Whatever it is, if it's an investment of some sort, I think no matter what, whatever the rates are, the momentum of just getting started versus using the interest rates as an excuse to hold back another year, see what happens. I think that missed opportunity, that missed growth of a year, wondering and waiting, I think you're way better stepping in, and getting things rolling, and then worrying about the interest rates with a refinance or kind of paying attention as things go and adjusting and audibling. I mean, really, at the end of the day, that's all investing in businesses is moving forward and calling an audible when you hit an obstacle and pushing through to the next one, and, just keep trudging down that path.
Yeah, for sure. And I think one of the biggest emotions that comes with investing, or the biggest emotion that comes with starting a business, that's the most painful, I think, is regret, right? The regret of, man, I really wanted to do it, but I used some excuse that was out of my control to stop me from moving forward. And I think that regret is just, to your point, regretting the opportunity cost that was missed out, the growth that was missed out on not moving forward, I think is going to hurt way worse than having a 7% interest rate versus an 8%, you know, dilly dallying back and forth over 1% versus the regret that you're going to feel being behind the eight ball for a year. Um, that just doesn't sound as fun. Think of, and I guess this will be more of a question. You know, think of a physician who is wanting to start their own practice. Part of that becomes real estate, right? They got to get some type of commercial property to have their practice at. What do rates look like today with commercial real estate, and what does supply look like out in the market for someone starting to practice?
Yeah, I mean, if they were going into the commercial world, and it depends because the rates are going to be around 7%, but
Mm-hmm.
depending on the past experience, the banks are very risk off right now. They don't want to lend on anything risky. So to lend to a new person who's just getting started and has never done this before, it's going to be a lot riskier proposition for the bank. So they're going to be not necessarily have a higher rate, but they're going to be less likely to lend money to that person. So that's going to be a greater barrier of entry. Which, with every greater barrier of entry means that 9 other people are not going to push through that obstacle. They're just going to give up. And if you push through that, you're going to be the one that does start a practice. And, realistically, most of the successful businesses, if you look back in history, a lot of them start during times of recession or down times. And I believe my personal opinion of that is because most other people that would have started during a good time, they just don't have that courage and that willingness to push through during the downtime. So they just never start. And then that one that does do it, if you can do it in a bad time, you're going to be able to crush it in a good time. So rates will be around 7%. There's going to be a ton of obstacles to get in there and get things off the ground. The SBA obviously has loan options, for different businesses as well. But it's going to take experience. And at this point, if you can't break through that, some of the things that you could do is reach out to somebody else who's in private practice, maybe partnering with them and talking with them to try to get some of that experience on your side, get some more backing as far as assets behind you, to be a little bit less risky for the bank. Those are just a few options to kind of get things going if you're looking to start a private practice.
For sure. And so if banks aren't willing to lend, they're a little bit more risk averse in that space of lending out right now. Does that physician, that soon to be or aspiring business owner, they just need to come up with more capital to get started?
Yeah, they need to reduce risk in some way. So more capital that the bank can secure their loan against, or use in the SBA, where the SBA guarantees a large portion of that loan, or just having assets besides capital. But any way to reduce the risk, bringing a partner on that has that experience where the bank feels safe that person's going to be guiding you and be a part of the deal. Anything to reduce risk for the bank is going to be what's necessary if you don't have that experience. If you're looking to expand a practice and you have the experience and a lot of success, might be a golden opportunity because a lot of people can't really get the ball rolling starting off, where you can kind of gain more market share and expand a little bit with your proven track record at the other one as well.
Yeah, gotcha. And just to clarify, when you say that experience, you're not necessarily talking about, I'm just thinking like a group of anesthesiologists. They want to go out. They have decades combined of experience doing anesthesiology, but actually running a business. That's what the bank is looking at to say, hey, these guys are really good at what they do, but actually operating a business and keeping it afloat, they don't have the track record. Is that what you mean by experience?
Yeah, a little bit of both. So, I mean, if
Okay.
you have both of those, if you've run a business and you've been a physician for 10 years, you're going to be in the best boat. If you never run a business, but you got a team of people behind you and you've been doing it for 10 years, likely you have a solid net worth and some assets behind you. You got a proven track record within your profession, and you can show some guidance and show a nice plan for the reason why you're going to private practice. That's all going to help. But yeah, if you're a private practice, you've been a physician for years and you've done private practice and run a business for years, that's going to be the least risky. That person's going to be the most yeses from the bank with the lowest rates. If you don't have that, you got to offset it with something. You can't just really come out of school and say, hey, I'm attending now. I want to start a private practice. I have no money in my pocket. All I have is debt. I've never done this before and I've never run a business. That's going to be very hard to get a yes from the bank. Where before, honestly, when the Fed rates were at zero, the banks had kind of unlimited money. They were willing to take a risk on things like that. But right now, it's just a lot more risk adverse to those types of situations.
For sure. So thinking about the right now, again, there could be somebody listening that's like, man, I was getting ready to open my own practice. I've been thinking about it for months. I'm ready to pull the trigger, but then I listened to Mike and Nate, and now I'm not sure what resources are out there. I think of like Grand Vision companies, like people that you can partner and give advice and things like that. What resources do you think are out there for physicians that uh, are really good at what they do? They've been in the hospital setting for, let's say it is a decade, but they've never run their own practice. What are some of the resources that they should be looking for to kind of get them to that next step where the bank is like, okay, we're willing to give this a chance?
I mean, I think always the best resource is just going to be finding somebody who's walked that path before and teaming up with them. So
Proof of
reaching out to
concept.
somebody and seeing how that's going to work. But yeah, anybody who's walked that path and done it in the past, they got the experience of hitting those obstacles and figuring out how to get around them. That's where the risk is hitting an obstacle and not being prepared or know how to get around it. So I just think anybody, whatever industry it is, finding somebody in that same industry that's further down that path that's going to help. If we're talking private practice specifically, somebody who's been successful at private practice in the past.
Yeah, for sure. What do you think the biggest obstacle is for anyone? And I guess I'm leaning out of the private practice space and just talking more holistically. What's going to be the biggest obstacle for people who are wanting to borrow over the next couple of years if rates don't change? Is it getting comfortable with 7% being the new normal from a lending perspective, or is there other areas that they should be focused on?
I mean, it all depends on what they're borrowing money for.
Mm-hmm.
So, like I said, if you're borrowing money just to buy cars and houses, then there's always going to be kind of a government, I don't want to say subsidy, but there's always going to be government programs that force those rates to stay stable and make sure that enough people, because we need the velocity of money to keep the economic engine running. And then on the investment side, if you're borrowing to buy real estate, which is kind of the number one besides a private business, but if you're borrowing to buy real estate, then I think, I think that's got to be, you got to pull the trigger and get things rolling because, like we talked about, the experience with the bank. Let's say 5 years down the road, if you still have zero experience, you're going to be in the same boat. But if you start with something, just get the ball rolling. 5 years down the road, now you have the experience. Whatever economy we're in at that point, now you got 5 years of experience to be able to take advantage of whatever presents itself 5 years down the road.
Gotcha. Oh, that's a good answer. Um, from an economic standpoint, just thinking about investing, that's part of what Grand Vision companies does is real estate investing. You're always looking at interest rates from a borrowing perspective, but let's talk about it from a growth perspective as the investment. I read a stat somewhere so the largest generation, the baby boomers, a lot of them entered retirement, around age 65 in like 2010. The youngest baby boomers, will be entering retirement around 2030. And so there's been a lot of cash. All those people have been in their prime earning years over the last 20 years or so, and they've been investing those dollars. As capital then, in their minds, shifts more towards these are my retirement dollars. Like I had this capital for investing, now these are my retirement dollars that I need to live on. What does that mean for like you and me as millennials from a capital perspective? If we're wanting to go out and start a business, invest in certain areas of the economy, what does that mean for us when that capital opportunity, from potential investors is slowing down a little bit because now those people are repositioning those dollars to be more retirement focused?
Well, it depends if you have capital or not. So if you have capital, there's a void now pulling out that you now can put your capital to work where that used to be. So for instance, private businesses, as that boomer generation starts, and a private business is typically going to retire at a later age. They're going to run that business
Good
because
point.
it's kind of their passion as well as their business, making money. But as those businesses, those owners start to get to a point where they're going to step away from the business, those opportunities open up to be able to place capital in that business, keep it running and grow that capital as well within that business. Same thing in real estate. There's going to be a number of people. We've even had people call that say, my kids don't want this. I got this apartment building. I thought I'd have forever. The kids have zero interest. And now they're looking to sell, which is that same thing, looking to cash out equity and basically park money into a safe, place for retirement, which opens opportunities for us to buy those properties that otherwise wouldn't be there. As far as the equities in the stock market, I stay out of that space as much as possible because there is such strong shifts that are out of your control. So as this generation reaches, as well as that, this is also one of the first generations now that doesn't have pensions. Their money is in 401ks and it's their responsibility. So as they start to shift 401k dollars out of the equity market and into safer guaranteed assets, that pulls money out. And if there's not enough money replacing that from the younger generations through their 401k, that's going to start to strip money out of the market and the equity side in general, which has a number of things that can happen, which is why I don't really like the stock market, is because that pull of equity, that sell-off could force prices down, or that could force the equity market to shift to more of a debt model and start to, if it forces the interest rates to stay high, because now the companies need to borrow money because they have a loss of equity that they did have and they got to keep growing. There's just a number of different ways that can have an effect if all of a sudden the entire boomer generation pulls all their money out of stocks, sells off, and drops it into, CDs and savings accounts. There's not going to be that sudden rush of money from younger generations to replace that. What that causes within the stock market is kind of up for debate. And I think the one thing we know is that is definitely happening. The thing we don't know is what effect will that have. And because we don't know what effect that will have, it's very hard to make a solid probability guess. And that's why I just stay out of the stock market altogether.
Yeah. No, 100%. If you think about that same boomer generation of when they were in their prime earning years, they're making the most money they have. Kids are moving out of the house. They're paying down, their house. A lot of that's happening between 2000 and 2020, right? That's when we were most capital rich. That's when, honestly, Wall Street was necessary and important during that time, because that's when everyone was piling money into their 401ks. They're building up a nest egg for retirement from 2000 to 2020. And so now as those people start to transition into retirement, you made the exact point of there's going to be that rush of dollars coming out of the stock market. And I think maybe the Fed sees that too, where they're looking at it to say hey, we need to come up with something new. Not to say that Wall Street and the stock market is going to completely disappear, but I think there's a lot of writing on the wall that people are looking at it to say, we've got to come up with a different model. There's got to be some shift here, because there is billions and billions of dollars that are in retirement accounts that the boomers are now going to start pulling out, and we got to be able to adjust and react to that. Especially if the millennials don't have all the capital to kind of refill the pot, right? They haven't hit their age 45 to age 65 age range yet, and so there's going to be that gap, and I think that's where alternative investments are really going to step towards the forefront, in building wealth, because there is just that kind of paradigm shift of the need for the stock market and for Wall Street to really carry out what we do from a wealth building perspective.
Yeah, I mean, a lot of the stuff, people like to look at numbers and charts and make a calculated logical decision, which would be amazing if our country ran on calculated logical decisions and make the game a lot easier. But a lot of it is emotionally based. And the reality is, if you have a lot of money in a stock market and before the bonds and the savings accounts are paying you 0.1%, you are kind of forced to keep money at work in some way because you can't live off 0.1% earnings. Well, now you can park your money and make 5%. Well, if you got a couple $1 million in your 401k, that's going to earn a decent amount of money at 5% over and over. So it's more likely that you're going to pull money out of the equities and park it in a savings account at 5%. So you have that pull. At the same time, those interest rates being higher on people in, their, let's say 25 to 45 age range, they're buying things, consuming, buying houses. Well, rates are higher, which means the cost going out every month is going to be higher for them, and they have less money now to put towards their 401k and their retirement, because it's unlikely, from a logical standpoint, people would buy lesser and have lower payments so they can keep saving for retirement. But that's not what's going to happen. People will pull from retirement to be able to buy the house they thought they should be able to afford. And just because it costs more money now, they're just going to pull from somewhere else to be able to cover that payment. So these rates and the pull of money out of the market and the demographics changing, like I said, charts and numbers and running calculations from a straight logical standpoint, it'd be very easy to say this is exactly what's going to happen. But from the emotional standpoint, people don't make logical decisions with their money. So it's very hard to know. And that's why, as you see these things play out, you just got to kind of pay attention and audible as necessary. But also that's why I think that 2 to 5 year time frame was saying this is what rates will be, or rates are going to climb. That's assuming everything goes as planned and logic runs its course, which there's no way to know what emotional impact will have, but you do know that 2 to 5 years of straight logical decisions is not likely.
Not realistic, right? Yeah, that's assuming that everything goes according to plan, which it never does. And I think it still goes back to what we were talking about earlier, kind of that deglobalization of the reliance on China and kind of those Eastern countries from a manufacturing standpoint, from a goods and services standpoint, and us leaning back towards American made, right? Like we said earlier in the show, like it takes time to build that up. And so as that buildup's happening at the same time that that baby boomers are pulling dollars out, I think that's where for kind of the younger people listening to it, when I say younger, I mean our age, the millennial generation, that there's a lot of opportunity regardless of interest rates. And if interest rates are where they are today, a couple years from now, there's a lot of opportunity for millennials to really start taking some action, right? To really grit it out, like you were talking about earlier, and don't pause, don't be scared to take that next step in your path that you are needing to take, because there is a lot of opportunity coming with American employment, American capital, and all of those things. It's just going to take a couple years to get that infrastructure in place. But once it's here, man, there's going to be a lot of demand. Like it's going to be expensive to get it going, but there's going to be a lot of demand. And I think that's super exciting.
Yeah, for sure. One thing that I just thought of as well, you're talking about private practice and starting off, if it were me, if I was starting off doing something right now and I wanted to kind of open my own practice, a very safe way to do it to make it work much better is, we talked about the boomer generation kind of getting to their retirement age. Most of these people that are physicians are selling off to private equity, which then comes in, rolls up a bunch of small practices into a bigger one. But if I was a young person and I want to start my own private practice, I would go and reach out just like private equity is. And I would find one of these physicians who's looking to retire, who doesn't want to sell out to Wall Street, who wants their practice to stay the way it always was. And they want to take care of their employees. They want to make sure that Wall Street doesn't come in and fire their staff and do things their way. I would go find one of these people. I would work with them for a couple of years with the understanding and probably an option of some sort to be able to purchase the practice and have that conversation where I could cut my teeth and I could learn from the person who ran it for years. I could gain the experience in the eyes of the bank. And then I would know that when this person's ready to step away, I'm going to buy them out and take over that practice. I think that'd be a win-win for everybody. That's a win for the older person who would like to step away and they don't want to see a ton of changes happen to the practice that they built over the decades. And it's a win for the younger person stepping up because they don't have to learn everything on their own. They don't have to build a startup with no experience. They can gain that experience and that confidence of the bank to be able to step into that role. So in a perfect situation, if I was looking private practice, that's exactly how I would do it.
Yeah, that's a fantastic point. I think that makes everything that we're talking about geopolitically, economically, we can kind of talk high level or really get in the weeds, but I think from a relatable standpoint, you hit the nail on the head there. That was really good. My thought, though, as you were saying that, is they're in there, they're cutting their teeth for a couple of years. There is that contract or that understanding. Okay, in the next 2 to 3 years, previous owner is going to slide out, new guys coming in here. What does that mean from a borrowing perspective for them to be able to initiate that buyout? What are some things that physicians who maybe heard that and they're like, bingo, Mike, that's exactly what I want to do. What obstacles are they going to bump into from a borrowing perspective there?
I mean, there shouldn't be any obstacles if the business runs well. It should be a nice, smooth transition. You should be able to basically take out a loan for the buyout portion to pay that person off. Maybe the person who's retiring wants to stay as a partner and just take distributions rather than a one-time payout and have a huge tax consequence. Maybe they want to take small, kind of a seller finance approach. Maybe they just want to stay as a silent partner and take distributions each year in addition to some sort of money. So, I mean, there's a number of different ways to structure that deal. But when you talk about obstacles on the lending side, that is going to be the least amount of obstacles. Not to say there won't be any. There's never a deal that has zero obstacles. But if you're talking about the least number of obstacles and the smoothest process, that is going to be the smoothest process because you have experience, you have proof of concept, you have financials, you have everything laid out with a track record of a few years. That's going to be very simple deal to do.
Sweet. Okay, so I appreciate that clarification because that was where my understanding kind of there was a kink in that because I was like, well, the person that's coming in, yes, they cut their teeth for a couple of years, but they still have not run a business. So you're sitting down with banks all the time, and so you kind of understand how they're thinking from an entrepreneurial perspective. You know, what's the lending look like? How much trust can we put into this person to succeed and pay off this debt? I was thinking, okay, new person comes in, they have not run a business. Yeah, existing business runs great because this guy who's getting ready to retire has built a great business over the last 25 years. I mean, new guy coming in could derail it, but to your point, they're looking at the business and its operation, and then they just kind of tie to it. Hey, new guy has been here. He understands the system. He's going to keep this thing moving along. There's really no obstacle for us to be able to lend to this new guy because he's just going to keep the train rolling as it was.
I mean, yeah, and one of the biggest risks in the physician world is losing patients. You know, I mean, if you have a book of patients that is, let's say you have 3,000 patients, but they all love the doctor who retired and they hate you, that's a huge risk that you step in and all these patients never show up again and
Is
you
the
just
bank
lost that
looking
book
at
of
that?
business. Oh, I mean, that's a huge risk factor. Yeah. Because there's no guarantee. There's no way besides insurance, which isn't really in your control. There's no way to force a patient to stay with you. There's no contracts or anything that says you can't go find another doctor. So that's a huge risk, which also eliminates that risk if you're there for a few years to start to get to know these patients. And it's a slow transition out versus a patient showing up, seeing a new doctor and saying, whoa, where did, Dr. Crannell go? Oh, he retired. He's gone. They might say, nobody told me I'm not for this. And of course, it's not that stark. It's not like even a buyout doesn't happen that abruptly.
Sure.
But to slowly progress into that is going to be a much smoother transition and much more likelihood for patient retention afterwards, which obviously affects the financials.
Yeah, and I think the strategy that you kind of laid out of if it were you, here's what you would do of coming in and cutting your teeth and being a part of that for 2 or 3 years. I think the obstacle that you just mentioned, which isn't really realistic, I guess. People aren't just going to up and leave all of a sudden. They're like, hey, wait a second. I thought I was supposed to see, Dr. Neubauer, and all of a sudden it's Dr. Crannell. Like, what's going on here? I think that reduces it to where if they're in there and they're seeing you over the last couple of years and they've had conversations with you and they know, hey, I'm either going to get one doctor or the other because they're both here. And then there's that smooth transition of, elder doctor is going to be leaving and you announce it 6 months in advance and everyone's kind of aware. I think your retention rate is that much higher if you do stay in there for 2 or 3 years versus, and I'm not as privy to this, so I don't quite know, but like versus a private equity coming in and kind of cleaning house on like, hey, these doctors are costing this place money. Let's get them out the door. I got to imagine some of that is happening. And I think that retention then becomes a lot more difficult. But if it's a smooth transition from elder to younger statesmen, as it will, in the practice, to your point, there's just not a lot of obstacles that can get in your way of making that a smooth transition.
Yeah. And even you brought up private equity. I mean, that's what private equity does as well. When they buy out, they keep the physician on for a time period. So behind the scenes, the owner change, but to the patients, they don't see the change. And they do that because they can't go in and clean house because they lose too many patients. There'd be too much change happening all at once that patients wouldn't stick around. So even the private equity realizes that, and they slowly transition. And, if you get bought out, typically you're going to be signing a contract to stay for a certain period of time to make that a nice, smooth transition for that new owner.
Gotcha. That's a good point. What do you think? And this might be one of my final questions, but I'm still thinking about private practice. Now I'm thinking in the eyes of the elder doctor who is in that boomer stage. They are wanting to retire and get out of here in the next couple of years. What should they be looking for? And maybe this is more of an HR question. You talked about a younger physician if they're wanting to start their own practice, but the least barriers of entry are to come in and be a part of an older practice and take that over. What should older practice owners be looking for? Is it private equity is going to get you the biggest number? Is it a pride thing? I want my practice keep running as it is, and I want to bring in a younger person, but being mindful of, hey, in a couple years, I'm no longer going to be a part of this practice, and I'm going to be in my retirement years, and I know what interest rates look like. I know what geopolitical issues are going on. I need to be cognizant of that. What should those baby boomers who own that, legacy practice, what should they be looking for?
Well, I mean, let's be honest. Most of the people listening to the podcast are going to be a younger group.
For
So
sure.
most people probably that are in their 60s and 70s probably won't hear this. But if they are listening to a podcast in their 60s and 70s, I think that's the number one thing. People focus on a dollar amount. They focus on a sale price. They focus on, a cash out price. They pay a ton in taxes. They lose a ton of money. Most physicians don't pay attention to their taxes, besides the fact that they hate paying that high dollar amount. So you go a whole career of paying stupid taxes for no reason, just because you don't understand the tax code. And then you get a high dollar amount and you see that big dollar amount and you, again, just kind of put off the tax consequence and you take that dollar amount. Building a business, private practice is just a private business. You are going to have way more success by personally operating that business than you ever would in the stock market where somebody else has total control. So to me, I think it's wild that most of these people sell out their business to private equity and take a big payday. Because we talk about like having an apple tree that produces apples year after year versus a basket of apples. When you sell that practice, you're basically taking your apple tree that has produced for decades and will continue to produce just with a new person, harvesting. But you take that apple tree and you trade it in for a basket of apples. Half that basket gets taken by taxes to the government. Now you're left with half a basket of apples. And now you're supposed to live the rest of your life and, inheritance, whatever. However many apples are left in there is what you get. When they're gone, they're gone. I think it's wild that they sell off these companies all the time and give up an apple tree that could produce for generations and retain some ownership and trade it in. So if it were me and I was selling a business that I had built, I would definitely be looking to keep an ownership and keep a distribution. I would not focus on the valuation of being what the number is, but I would not be focusing on that for the cash outside of things. I would get enough money to, make it work for me, but I would definitely be looking to seller finance. And I would like to take monthly payments versus a lump sum payment that I'm just going to go put in the stock market in somebody else's business. I would rather keep it in my business that I built where, I sell to somebody I trust that's going to keep the things going in the right direction. I think that's a safer play and it's a better legacy play for sure. So I think that's what people should be looking at. I don't think many people do. I think many people get wowed by a big number on a check and they look past all of the consequences of that big number. And, a generation or two later, all that money, all that hard work is gone to nothing. That basket of apples has been long spent.
Yeah, for sure. And we're having conversations now with people selling their business and getting that big number with several zeros in it. And how that all plays out. Is that something that, within Grand Vision companies, are those conversations that listeners could be calling you and saying, hey, I got this situation. What do you think?
Yeah, for sure. And, like some of the people we talk to, if you're selling a business and you're getting a big number, it's not always a bad thing. I don't want to say it's always a bad thing, but to have that be the sole focus, I think is if you're taking that big number and you're going to roll it into some new tree, you're basically trading in one apple tree for 4 apple trees. It makes sense. But if you're just taking that big number and parking in a savings account, parking in, the stock market, whatever, that's the part that doesn't make sense. So I think there's times when you have built a business as high as you can and you can get the most for it. But as long as you properly transition those dollars into a new investment to limit tax liability and continue cash flow, not just getting a big payoff, I think that can make sense. And that's obviously, like with the family office and stuff, that's a lot of what we'll be talking about with people is not getting that tunnel vision on just a big dollar, but what is the next step? How do you keep the apple tree growing? How do you keep, making the right investments, not just a one-time payoff?
Yeah, for sure. I mean, I think that could be a whole nother episode as we work with physicians all the time and especially in the family office and designing that legacy, designing what their future looks like. Some of them that do have private practices, there needs to be those conversations. Don't wait until you are that boomer, right? You're not the person that is getting ready to sell off their practice for a big number. Create some type of legacy plan or transition plan of your business. Even now today, when a lot of the families that we work with are in their 40s and early 50s, some do have their own private practice. Some are wanting to get into private practice. Those transition plans and those legacy plans, design those now and understand you're going to work hard and you're going to build the value of this company from here to here, but you're not just going to sell it out for a giant number if that doesn't make sense for you at that point. There's going to be other avenues and other strategies that we can use to reduce the amount of money that we give to Uncle Sam and increase the amount that we can pass on to future generations within your family.
Yeah, I think probably, even though we talked a lot about interest rates and geopolitical and everything, now we're talking about private practice. I think really what it comes down to is just having a proper plan. I think that's the problem is most people, physicians or not, but most people just don't have a long-term or even a well thought out plan. They're just going through the motions day by day, trying to make another dollar. And then when they make the dollar, figure out what to do with it. If that plan is in place, everything's a lot easier. And I think that's, talking to the private practice and the selling out, I think a lot of the physicians didn't plan on that 10, 20 years ago to have this transition and this sale. And because of that lack of planning, you're caught off guard by a last minute, offer to sell. And there hasn't been a lot of thought gone into it before then. So
absolutely. All the more reason to go to grandvision.co, schedule some time with Grand Vision and see where it goes from there. What are your final thoughts?
Final thoughts are, man, I wish interest rates would come down. That'd sure be nice for me. But I do think higher interest rates are going to keep competitors on the sidelines. It makes it more difficult to enter the space. It makes investing and running a business a lot more difficult. The more difficult it is, the more difficult it is for new people to enter, which keeps competition down and kind of gives a stronghold for where we're at. So when money's easy, everybody can kind of enter the sandbox and start playing. When money starts getting tight, then you're able to do things that other people can't, which gives you a little bit of a leg up. So as frustrating as it is to pay interest payments and see that money go to the bank, it's also nice to know that a lot of people aren't able to enter that space in the investing world because it's just too much right now.
For sure. Good final thought. We will we'll keep our finger on the pulse of all the things economically that are going on that are going to impact our physician listeners, and we'll have another episode coming soon. Good talking to you, bud.
We'll see you, man.